The broadcast is now starting. All attendees are in listen-only mode.
Good morning. I'm Todd Rosenbluth, head of ETF and mutual fund research at CFRA, and I'm excited you're joining us for Understanding Actively Managed ETFs. Before we get started, I want to remind you that today's session is being recorded, and a link to the recording will be made available within the next few business days. During today's session, you may submit questions using the GoToWebinar panel, and we'll do our very best to answer as many questions as we can. We're aiming to do this in 30 minutes, a little bit shorter than we normally do our webinars, because we're going to have more of a fireside chat conversation with one of our panelists. And with that, let's kick things off. On the next slide here, just to introduce, you've seen a picture of me beforehand, to bring Dodd Kitsley and introduce you to him. He's a national director at Davis Advisors. Davis, as you'll hear in a few moments, recently launched actively managed ETFs within the last few years. They have a proven brand and a strong track record in active management through mutual funds. We've been covering them at CFRA for a number of years, and they're extremely appropriate to have on this panel and on this conversation with us, and specifically Dodd, who I've known for a number of years in some of his prior roles. He is one of the forefathers in the ETF industry. So, Dodd, I'll say hello to you, and then we'll come back to you in a moment. Dodd, welcome to CFRA's webinar.
Thanks so much for having us, Todd.
A pleasure. So we're going to just show you, everybody, the agenda on the next slide here of what we're going to end up covering within the overall presentation. I'm going to talk about the overall ETF landscape and then specifically the active ETF universe and demand that's out there. We'll talk about a range of different products, how CFRA covers equity ETFs and fixed income ETFs, how that is different than our coverage of mutual funds. We'll bring Dodd back into the conversation to talk about active ETFs and what is important to know about how they're different than market cap weighted products, how they're different than active mutual funds. And then we'll come back in to not only do some questions and answers from the audience, but also just how you can learn more about the commentary we're talking about within this panel. So on the next slide here, let's just get a lay of the land. So we're coming in to about $4 trillion of U.S. ETF assets. It's possible we'll get there in the month of June. At this rate, we've seen a bit of a pullback or more net outflows happening in the month of May, given the volatility that we've had in the broader market. But a really strong year, or start of the year, over $80 billion of net inflows in the first 4 months of the year, as you can see on the left-hand side of the screen. And what jumps out to me is the heavy lifting that's happening within fixed income ETFs. Almost half of the net inflows have gone to fixed income ETFs. You can see on the right-hand side, they're less than 20% of the overall pie. But we are seeing net inflows into U.S. and international equity products. The part of it has been the market moving higher, but investors have been focusing more on a defensive parts of the market as well in 2019. So let's move to the next slide here, specifically talking about active ETFs. We've continued to see them being used as a replacement for individual stocks or bonds, if we're talking about bond products, and for mutual funds. That's happening for ETFs, but specifically with active ETFs. Now, active equity mutual funds have seen pressure in recent years. There's been net outflows for the last few. And yet you can see on the bottom of the screen, the net inflows to active ETFs quadrupled in 2018 relative to 2016 and almost doubled year-to-year basis. And so on a percentage of the net inflows in 2018, near 10%. That's really impressive given that active ETFs are just 2% of the overall pie that we saw earlier of $3.9 trillion in assets. A lot of the heavy lifting took place in 2018 in the active fixed income space, specifically in ultra short bond products offered by PIMCO, offered by JP Morgan, offered by iShares. And these products were particularly popular on concerns of rising interest rates and the volatility that could have caused in the marketplace. And so those kind of products like JPST from JP Morgan in particular had appealing both income and safety combination. So we really saw it in the fixed income space. But for this panel, in this presentation, we're going to talk about actively managed equity ETFs. And so let's move here to the next slide here to just show you the lay of the land. So we've pulled the 15 largest active equity products. Again, these are still relatively small compared to the products that are out there in the passive space. But we've seen in not only in 2019, but specifically in the month of May, active ETFs have seen net inflows and passive ETFs have seen outflows. And that's something obviously that is a trend that could continue. Let's talk about some of the funds that are listed on here. We're going to get to Davis in a moment, so I'm going to leave those out for the time being. The largest product, EMLP, is from First Trust. It combines energy and utility ETFs. So for folks that are looking for MLP exposure, this is a bit of a twist on that. This more than $2 billion product. ARK has 4 products that are on this list. The second overall ETF, ARK Innovation, ARKK, is a $1.7 billion ETF. It actually is combining some of the themes that you see lower down on the table from genomics, from industrial innovation, from Web 2.0, and stocks inside this portfolio include Tesla, Twitter, Illumina. These are more higher growth oriented individual stocks. And then the last theme I would just highlight here is we've seen sector rotation strategies. There's a couple of those products or market rotation strategies. Active ETFs have been, active equity ETFs have been a good way for investors to, and some of the investment strategies out there to put in an ETF wrapper and have it execute all of the trades that are happening if they're running a model portfolio or a model portfolio of individual stocks. The ETF wrapper has done that. But Davis is really the only firm that jumps out here to me that comes from the mutual fund world. Davis has a long history, 50 plus years of track record for some of their equity strategies. This is, I'll let Dodd talk more about that, but there's 3 products that are on here, DWLD, DUSA, and DFNL, that are among the 15 largest of those products. So before we get into talking with Dodd, let's just remind you about CFRA's overall coverage and how we go about covering not only active equity ETFs, but also index-based products. So we cover more than 1,200 equity ETFs. We have what we believe is a forward-looking approach that is based on the data that's out there. So we do analysis at the holdings level. I'm sure many of you know we cover 1,500 stocks or more qualitatively with a strong buy to strong sell recommendation globally, several thousand more on a quantitative basis. We're combining that holdings level analysis with fund level attributes such as the expense ratio, the bid-ask spread, and technical analysis. For fixed income ETFs, we're over 250, now over 260 ETFs. We're looking at the credit quality, the duration, and the yield on more of the holdings component and those cost and liquidity metrics. What I think is particularly compelling given the space we're talking about is that nearly 30% of our coverage universe are products that have launched within the last 3 years. There's others that are out there that are rating ETFs looking at its 3-year track record. If you did so, you'd miss out on some very compelling equity and fixed income strategies, including the ones from Davis that we'll talk a little bit more about, including JPST from JP Morgan, that highly popular short-term active bond product. It's not covered by some firms because it doesn't have a 3-year track record. Separately, we rate mutual funds differently than we do ETFs. It's a different rating methodology. We cover 12,000 equity mutual funds, nearly 6,000 fixed income mutual funds. You'll see some of the same metrics that are being used for ETFs are being used for mutual funds, but for mutual funds, we are incorporating the fund's track record and manager tenure, which is something that's more relevant in the mutual fund world than it is in the ETF world. Now we move here to the next slide just to give you a bit of a description of the way that we do our overall research and in comparison to Morningstar star rating. more forward-looking holdings-based metrics. We're leveraging the 75 equity and accounting analysts that we have here at CFRA that are providing a fundamental valuation and risk assessment of the stocks inside the portfolio. Highly focused from a risk perspective at looking at earnings consistency, looking at the company's balance sheet that makes it into the portfolio. And then we agree with others in the industry that you should take a look at costs and total cost of ownership. So not just the expense ratio, but also trading costs. That is part of our overall rating methodology. Now, with that as the background of overall the ETF landscape and also what we at CFRA are doing, Dot, I want to bring you back into the conversation. This slide here is going to lay out the topics that Dot and I are going to cover. We will move in part of the discussion to the next few slides to give you some data to back up some of the things that we at CFRA are thinking about tied to these topics. But Dot, let me pause here, ask you to just introduce Davis and why you guys got into the ETF business a couple of years ago.
Thank you very much, Todd. Yeah, so Davis is an independent employee-owned asset manager. We're equity specialists, research-driven. We only have 5 core strategies that we manage, and we entered the ETF business after 50 years of managing mutual fund assets and later on separately managed account delivery vehicles as well. We entered the ETF business because, frankly, our clients asked for it. They asked the reasonable question of, can I access Davis and your investment discipline with an ETF? So long story short, we did our work and due diligence and realized because of the way we manage money, because of our focus on long-term investments that's relatively low turnover, large liquid securities, that we were very uniquely suited to be among the first to launch time-tested, proven active management in our strategies that have been around for decades in a traditional ETF wrapper.
So thanks for that. So we'll use the question that's here on this slide as to why do you think there's so few actively managed equity ETFs that are out there?
There are a few reasons to that, Todd. I think the first is perception. I think a lot of folks still equate ETFs with indexing, and that's truly a false dichotomy. The light bulb that's kind of gone off in a lot of investors, advisors, and certainly asset managers' heads is that ETFs aren't just about indexing, but what they really are is about offering an efficient delivery vehicle. It can be indexes, but it can also be market segments, and in our case, strategies. There's another reason why that's more on the asset management side of things, and those are concerns around giving away the secret sauce, being fully transparent, which a traditional ETF wrapper requires, as well as concerns around front running. Our view on that is a lot of those are kind of overblown and over-exaggerated, but they can be real concerns if one is managing a more tactical type of investment with higher turnover and in less liquid securities. Not everyone was in the same position as Davis, so certainly the way we manage money made a big difference in terms of being able to have the traditional ETF structure as a viable delivery vehicle. But there are a couple other more subtle things too. Davis is already low cost in our mutual funds, so it was palatable for us to be able to launch an ETF at roughly the same expenses as our mutual funds, and not create a price arbitrage type of scenario. And the final thing, which I think is really important as well, is at Davis we have a culture of transparency. We see transparency as really a virtue, in something that investors have the right to know in terms of what they own, as well as the investment case behind each and every line item within our portfolio. So the stars aligned perfectly for us, maybe not for everyone, but it was really a match made in heaven, and we're thrilled to be among the first to do such a endeavor.
Thanks, Todd. And we moved earlier while you were talking to the next slide, just to put some perspective on some of the things that you ended up talking about. I'd add in here that some of the firms that traditionally have had an active management mutual fund lineup have dipped their toe in with smart beta products, creating an index-based approach, and perhaps that is a starting point for them before they end up ultimately moving into active. Maybe we can just highlight again that there isn't an index behind the Davis lineup, and why isn't there an index behind the Davis lineup instead of just having a truly active approach?
Yeah, it's a great question, and one that I get all the time is, why didn't you just launch smart beta index-based active strategy? And the answer to that really is the value that we've delivered to investors over the decades, and the wealth that we've helped create is something that cannot be distilled down into a quantitative stock screen or a set of rules. And at the heart of smart beta, it's really just that. It's following a set prescribed set of rules. And our value add, we believe, combines both the quantitative as well as the qualitative. So putting a premium on experience, on judgment and discretion, that's really what we do in terms of deeply understanding the companies that we own and their competitive landscape and their customers, their culture. We think that some of those intangibles really can make a huge difference in terms of outperformance over the long haul.
Well, we'll move to the next slide here to just show an example of how DUSA, which is one of the products that wanted to focus on the U.S. equity space, how that compares to, we're using SPY as the reference for the S&P 500 index, and then we're using a smart beta multi-factor ETF from Goldman Sachs, GSLC, and the audience can be able to see, again, the number of stocks, the overall weighting within individual stocks, and then the sector composition, or at least the largest sector that's there. So I'll ask you maybe to talk about this and from a bottom-up perspective, how DUSA is constructed differently, and then I'll have a follow-up.
Yeah, it's a great contrast, Todd. So all of Davis portfolios are extremely selective. We're completely benchmark agnostic, so we certainly won't own things for the sake of truing up an exposure to a country or a specific sector. We like to say we buy businesses, we're not renting stocks, and when we buy businesses, we're buying them for a very long period of time, or at least the intention to do so. So what you get is really a portfolio of, in our opinion, some of the best companies that are durable, well-managed, and really have the opportunity to compound growth over long periods of time. So there you'll see some of our top holdings have much higher weights than you'll find in a market cap weighted index, or even a lot of smart beta indexes. We're firm believers in what you don't own sometimes is as important as what you do. And again, we want to make sure that these are best portfolios of our research-driven process.
So I think that for some, the belief that actively managed ETFs is that there's constant trading, or there's regular trading that's happening within a given month, and we've obviously seen a sell-off to thus far in May. In the last 6 trading days heading into today, the S&P 500 was down 4.5%. We have on the screen here that portfolio changes can occur without warning. Can you, in the interest of transparency, talk about how Davis has been handling the volatility thus far?
Yeah, that's another great question, and you're right. It's a misnomer that active translates into higher turnover and more trading going on. the fact of the matter is Davis strategies have lower turnover than a lot of indexes, in particular smart beta indexes, have. Our view on the sell-off over the last week is very analogous to what we saw in the second half of last year, in that it was very much a sentiment-based sell-off. We, again, buy these companies with the intention of owning them over a long period of time, do an inordinate amount of work to identify durable companies that can withstand short-term volatility, have strong balance sheets, have strong competitive advantages that are going to be sustainable over long periods of time. So our view on this kind of trade war-induced volatility is that the companies that we own are fairly insulated long-term from the short-term volatility that we're seeing today. So you haven't seen a lot of kind of portfolio changes. And in the second half of last year, both the family as well, the Davis family, as well as the foundations that we manage, allocated a significant amount of money to some of the more depressed parts of the market that we think really sold off more than they should have.
So I'm going to move to the next slide here because we've on webinars talked a lot about index-based strategies and how hard it is for active management to outperform. I'm sure, know of the SPIVA scorecard. This is the latest one, looking at how hard it's been for the average active U.S. large cap, global equity, and international equity fund to outperform. For perspective, 50% would be on average. The funds would keep up with the benchmark, and we now have free and a number of nearly free ETFs. So I guess, how does active management have a chance, and is it more enhanced within the ETF wrapper?
Yeah, let me take it two ways. First, context on SPIVA. We're certainly believers that there's a lot of bad active out there. So I think when you look at the average, some of these statistics can be fairly misleading because they include high cost, benchmark hugging, non-aligned types of mutual funds. So if you take the other side of that and just do simple stock screens in terms of active managers that are aligned and have money co-invested with their shareholders. If you have managers that are relatively low cost, doesn't have to be rock bottom, but relatively low cost. If you have those that are willing to look different than the benchmark, you're already kind of two steps ahead in terms of finding an active manager that has been able to outperform over long periods of time. Our signature large cap strategy has more than doubled the return of the S&P 500 over its 50-year history on a compounded basis. So it certainly can happen, and it's happened here at Davis. But to your second part of your question, Todd, I think the ETF structure does offer some great advantages that have yet to be kind of seen because there hasn't been a lot of actively managed equity ETFs yet. But the cost savings internally can be material. And I'm not just talking lower expense ratios, but being able to externalize trading costs from the portfolio has a material impact over time, as well as the tax efficiency that the ETF structure can bring to the table. And frankly, we've seen a lot of Davis investors be attracted to the ETFs because of that tax efficiency side of the equation. So, but I think it's really important, as sentiment has shifted so far in the passive camp, that folks do take a contextual eye when they're looking at the SPIVA report and look beyond just kind of settling for average.
We would agree. So we use the research in our commentary, but what we end up doing when we write about the SPIVA scorecard is talk about funds that have struggled to keep up and that are expensive, and funds that have consistently performed well and that are relatively cheap. And so on this slide here, we just did a poll from our MarketScope Advisor database of funds that have an above average expense ratio, more than $1 billion in assets under management in that share class, It's in one of the three large cap peer groups, either growth, value, or core, and that have underperformed. So either in the third quartile or the bottom quartile of its peer group. And as you mentioned, there's a lot of funds that are popular or still have a lot of assets in there. They may not be as popular as they have been beforehand and that are struggling. So I'll leave the slide up here to then ask you my final question of, Davis offers actively managed equity mutual funds. You talk about it being the same overall investment strategy, but not the exact same portfolio. How do you think investors should be looking at active ETFs in general as part of their broader portfolio?
Yeah, I think investors really should reserve a place in their portfolio for active, and for those building, ETF models, there haven't been a heck of a lot of choices out there. So I certainly think that, looking at actively managed funds and ETFs in particular can provide both a diversification benefit as well as a performance benefit as well. But I do want to be 100% clear. Look, mutual funds can offer some advantages as well. And often people say, what is a trade-off between a Davis ETF and a Davis mutual fund? Well, with our mutual funds, we can include less liquid securities, in some instances private placements, that we would not want to include in an ETF because we want a basket of securities that's easily traded by the street that translates into a better experience for ETF shareholders in terms of tighter spreads. So said another way, I think you have a slightly broader opportunity set in the mutual funds, which can be very attractive in tax-advantaged accounts. And many investors are using the ETFs in taxable accounts to really kind of capitalize on the tax efficiency that ETFs can sometimes offer.
I completely agree. There's a lot of good choices that are out there. There's strong mutual funds that we at CFRA are covering. This happens to not be a list of those, but there are strong mutual funds, and there's strong ETFs for people who want to build the portfolio that makes sense to them and for their clients. As we move to the next slide, to just kind of move things forward, to remind you about some of the tools that we have on our MarketScope Advisor platform or on platforms that you may be getting our research from. And so on the right-hand side is a sample of one of our ETF reports. We talked about DUSA, so I wanted to show our overall coverage of this. We do ETF ratings from an overweight, market weight, and underweight approach, a three-tiered system. And you can see a sample of that report, and it's color-coded, so what's contributing favorably is green, what's contributing unfavorably is red, and what's neutral to the overall rating is yellow. On the left-hand side is a screenshot of thematic commentary that we write focused on funds under the Funds in Focus name. I author some of that content myself, and there's broader coverage within our team. We talked about the possibility of American funds launching in active equity ETF that would be non-transparent, given what's happening from a regulatory perspective. And American funds would certainly move the needle quite a bit. As strong a brand that Davis has, American funds is a much larger actively managed mutual fund company with a wide array of equity strategies that could possibly, in late 2019 or early 2020, exist in the ETF wrapper. On the next slide here, just to show you about what we offer as well. If you are not receiving this, and if you are, you know it, you would have gotten something earlier today, a weekly newsletter that we share with our MarketScope Advisor clients, pulling some of the thematic commentary that we published within the last week from myself, from Sam Stovall and Lindsay Bell from our investment strategy team, from our equity analysts covering various industries. You can see we wrote about aerospace and a number of other industry groups, a focused stock of the week that gets published, as well as a whole lot of other content. So I encourage you, if you're not receiving this, to let us know in the Q&A box that you'd like to sign up for this, and we'll certainly follow up as well for ways for you to be able to do that. And so with that, I want to move to the next slide here and show you that we've got as I open it up for questions, and we'll take one or two additional questions given the time constraints that we have. I'll move to the next slide here to just show you our upcoming webinar that we welcome you to register for. It's on May 22nd, where my colleagues from CFRA's equity research team are going to provide a focus on the biopharmaceutical industry, our overall outlook, and the impact of new balance of power in Washington, D.C. A link to register for this session will be sent to you later on today, along with a recording and the slides from today's presentation. I know many people have asked for the slides. They'll be coming later on. We wanted to make sure you were staying with us throughout the presentation, and you'll certainly have a chance to do so. And if there's questions that we do not get to, and we'll take questions as we move forward, I want you to know that you can always reach out to us at C-Services at CFRA Research, and we'll be able to help you out with more specific questions. So Dot, I want to take a question that came in specifically that I think is appropriate for you to be able to answer. Maybe we can just talk about the tax efficiency benefits a little bit more in depth from an ETF perspective. How is it more tax efficient than a mutual fund that you or others run?
Yeah, it's a great question, and probably the most common that I get. So essentially, the ETF structure helps protect long-term investors in a ETF from other shareholder activity. The biggest difference that creates the tax efficiency advantage of an ETF is the way that money is exchanging hands. With a mutual fund, shareholder accounting and transactions occur at the individual investor level. So money comes in, portfolio manager has to put that money to work. That incurs some transaction costs. With an ETF, most of the shares are bought are existing shares outstanding, but if there's an imbalance in supply and demand, then a creation occurs. And that is done in kind, which is essentially a fancy way of saying the whole portfolio pro rata is delivered into the custodian and new ETF shares are created. The tax efficiency happens on the outflow of dollars. So in a mutual fund, if there are a lot of redemptions, the portfolio managers have to actually liquidate stock, which can happen at a gain, and then all remaining shareholders at the end of the year are left holding the bag and have to incur a capital gains distribution, even on gains that they didn't participate in. With an ETF, when redemptions occur, those are also done in kind, which is not taxable at the fund level. So said another way, other shareholder activity doesn't create negative capital gains effects for remaining shareholders with ETF.
Right, and just to add to that, so if you as an investor or as an advisor bought and sold an ETF, that would be a tax implication for you, but it wouldn't be for anybody else that owns that product, whereas if somebody else sells out of your mutual fund, you may end up with a tax bill, even though you held on to that mutual fund for the whole year. So it's you pay taxes no matter what when you transact, but others may or may not pay it depending upon the overall structure.
That's a great way to put it, Todd. I mean, a lot of people say, hey, is there a loophole here? And it's not, right? You still have to pay taxes. With an ETF, you have more control over your taxable events, where you have less control in a mutual fund and you're at the whim of what other people are doing.
Great. And so I'm going to take an additional question that came in that was specific to our overall ETF research to explain a little bit more about how our holdings process is connected to our overall ETF rating methodology. So we showed on the earlier screen that Berkshire Hathaway is the largest holding within DUSA. We show that Microsoft is the largest holding in those two other ETFs. Our analysts have a qualitative forward-looking assessment of whether those individual stocks and others will go up or down. We also have a risk assessment of individual stocks using both our own qualitative assessment of the company's risk profile and then some other metrics like the credit rating from S&P to give us an understanding. And so we rate individual stocks from valuation and risk metrics. We compare in ETFs holdings, the latest available holdings that we have our hands on, with our assessment of the portfolio, and that helps to drive the overall rating. So in ETF, we'll get scored for 2 forward-looking valuation metrics and 3 risk assessment metrics based on the weighting of those stocks within the given portfolio, and then that is incorporated with fund-specific metrics like the expense ratio, like the bid-ask spread, like technical analysis of an ETF, and that gets refreshed based on any changes in the ETF itself and our analyst opinion on the underlying stock. So if our opinion on Berkshire Hathaway went up or down, or Amazon went up or down, that would certainly impact potentially the overall ETF rating. So a good question to let us drill down to it. So with that, and in the interest of time, we're a little bit past the 30 minutes I talked about. Again, want to encourage folks to stick around. I think there'll be a survey that'll be sent to you. Make sure you join us for our next webinar on May 22nd from my colleagues. And I want to thank Dodd Kitsley of Davis for, again, joining us as part of this webinar. Please contact us at cservices@cfraresearch.com if you have any questions about our research or anything that was discussed that we didn't get a chance to answer. Have a wonderful rest of your day.
Hanging up.